Welcome back to another Deep Dive with Taxes Explained. You know, um, Today we're going to try to tackle something that I think even, the most seasoned finance folks kind of find themselves scratching their heads a little bit about.
Yeah.
And that is CAMT regulations.
Yeah, you're right. CAMT, as it's pronounced, can seem like a real head scratcher. I mean, it's a hot topic in corporate finance these days.
And that's exactly why we're here, right? Anyway,
Yes.
break it down for you. No jargon, no spreadsheets,
It's the need to know.
just the need to know.
Exactly.
So consider this your cheat sheet to understanding CAMT and what it might mean, for your work or your investments or anything else.
Right.
Okay, so let's dive in. What is this CAMT all about?
Well, CAMT stands for Corporate Alternative Minimum Tax. So it's essentially a separate tax system that exists alongside our regular corporate income tax system. And importantly, it's not meant to replace regular taxes.
So it's an extra layer of tax then, specifically for corporations.
Yeah,
Yeah.
exactly. The goal is to make sure that large, profitable corporations are paying a certain minimum amount of tax, even if they've got all sorts of deductions and credits that might otherwise lower their tax bill.
So it's kind of like a safeguard then to
Yeah,
ensure that corporations are contributing their fair share, regardless of, how complex their finances might be.
precisely. Think of it this way. A company might be reporting huge profits to their investors, but paying very little in regular taxes. CAMT steps in to make sure they're still chipping into the tax pool.
I see. I'm starting to get the picture now. Not every corporation is subject to CAMT, though, right?
Right.
Who does this actually impact?
So CAMT kicks in for corporations that the IRS deems as applicable corporations. These are typically companies that have an average annual adjusted financial statement income exceeding certain thresholds.
Okay, hold on. Let's unpack that a little bit because adjusted financial statement income,
Yes.
that sounds pretty technical.
It is a bit of a mouthful. We call it AFSI for short, and it's essentially a company's income as reported on their financial statements, but with some adjustments that align it more closely with how income is calculated for tax purposes.
So it's not just about how much profit a company makes, then it's how that profit is presented and adjusted specifically for CAMT.
That's it, yeah. It's about creating a consistent basis for calculating this minimum tax, even if companies are using different accounting methods for their regular financial reports.
Okay, that makes sense. Now, you mentioned income thresholds. How high does a company's AFSI have to be to trigger this CAMT?
So for most corporations, the magic number is an average annual AFSI of over $1 billion over a 3-year period. So we're talking about some seriously profitable businesses here.
$1 billion. That's a pretty high bar.
Yeah.
So smaller businesses or startups, they don't really need to worry about CAMT then.
Generally, yes. However, there's a catch for companies that are part of a foreign parent multinational group, what we call an FPMG.
Okay, FPMG. What is that all about?
Basically, it means a U.S. corporation is part of a larger multinational group with a parent company located outside the U.S. And in these cases, the threshold for triggering CAMT can be a bit lower.
So even if a U.S.-based company, within that FPMG doesn't hit that $1 billion mark on its own, it could still be subject to CAMT.
Yes, because the calculation also takes into account the overall AFSI of the entire FPMG. If the multinational group as a whole has an average annual AFSI exceeding $100 million, then all of its U.S. subsidiaries could potentially fall under CAMT, even if their individual income is below that billion-dollar threshold.
So it's like a group effort then,
Yeah,
for lack of a better term. If the parent company's big enough,
right.
all the subsidiaries get pulled in,
Exactly.
regardless of their own individual size.
That's a good way to put it. And it makes sense when you consider the purpose of CAMT, to ensure that large multinational corporations are contributing their fair share of taxes no matter how their operations are structured.
Makes sense. Now, this focus on AFSI and these thresholds, has that changed how companies are approaching their financial reporting at all?
That's a great question, and it's something I think all of you listening should be aware of. Have you noticed any shifts in how companies, especially large corporations, present their financial data these days?
Now that you mention it, it seems like there's a lot more attention on certain financial metrics,
Mm-hmm.
even beyond just the bottom line profit numbers.
You're spot on, because CAMT is tied to AFSI. Companies are hyper aware of how their financial statements could impact their tax liability. They're paying close attention to things like how they depreciate assets, how they account for foreign income, all those nitty-gritty details that can ultimately affect their AFSI and potentially trigger CAMT.
So CAMT isn't just about paying taxes. It's actually influencing how companies manage and report their financial information.
Absolutely. It highlights how tax regulations can have ripple effects throughout the business world, far beyond just the immediate dollars and cents.
Okay, we've covered what CAMT is and who it applies to, but how does this actually work in practice?
Right.
How do companies report under CAMT?
Well, reporting under CAMT isn't exactly a walk in the park. It requires a pretty deep understanding of the IRS regulations and involves specific adjustments to that AFSI we talked about.
So it's not something a business owner can just, DIY with a calculator and a spreadsheet.
Definitely not. CAMT reporting often requires specialized expertise, either from in-house tax professionals or by bringing in outside consultants. There are a lot of moving parts and intricacies to navigate.
I can imagine. Can you give us a peek behind the curtain then? What are some of these specific adjustments that companies need to make when they're reporting under CAMT?
So one key area is depreciation. The way a company depreciates assets on their financial statements might differ from how it's calculated for CAMT purposes. There are also adjustments related to how foreign income, especially from controlled foreign corporations, is accounted for.
Yes. More acronyms.
Right.
What's a controlled foreign corporation in a nutshell?
Think of it as a foreign subsidiary of a U.S. corporation. The rules around how income from these subsidiaries is treated under CAMT can get quite complex.
Okay, so we got depreciation adjustments, foreign income adjustments. What else should companies be prepared to tackle?
Transactions are another big one. Companies use these strategies to manage financial risk, but how they're treated for CAMT can be tricky. There are specific rules and calculations involved to make sure the tax treatment aligns with the true economic substance of those transactions.
Wow. It sounds like there's a lot to keep track of. It really emphasizes the need for expert help when it comes to CAMT reporting.
Absolutely. These are just a few examples, and the specific adjustments can vary widely depending on a company's industry, their financial activities, and their overall structure.
So for those of you listening, if you're involved in corporate finance or accounting in any way, this is definitely something to keep on your radar.
It's essential to be aware of these reporting complexities. Even if you're not directly handling the tax calculations yourself, understanding the nuances of CAMT can help you make more informed decisions.
It definitely sounds like CAMT adds, a whole new layer of complexity to corporate taxes.
Yeah.
What are some of the biggest challenges that companies are facing with this?
Well, the regulations themselves are incredibly intricate. I mean, we've touched on a few of the adjustments needed for calculating AFSI, but there are countless rules and nuances that can be tough to navigate even for seasoned tax professionals.
So it's not just, understanding the basics.
Right.
It's about mastering all those fine details and applying them to very specific situations.
Exactly. And that level of complexity creates a huge administrative burden. Companies might need specialized software, additional staff, or have to bring in external consultants just to ensure they're meeting all the reporting requirements.
Yeah, and those costs can add up quickly, especially for smaller businesses that might already have limited resources.
Absolutely. And then there's the issue of potential double taxation.
Double taxation.
Yeah.
Oh, that sounds like a nightmare.
It can be a real concern. Since CAMT is its own separate system, a company could end up paying both regular corporate income tax and CAMT on the same income.
So it's not just about, figuring out the complex regulations. It's also about managing the potential financial hit of being taxed twice.
Precisely. It's a multifaceted challenge that companies really need to be prepared for. And speaking of challenges, there have been some recent developments that added even more complexity to the mix.
You're talking about Notice 2024-33.
Right? That's the one.
I've heard that's been making waves in the tax world.
Yeah, this notice issued by the Treasury Department and the IRS back in April 2024 essentially provided some relief for companies who were struggling to estimate their CAMT liability.
So it's a bit of good news then amidst all this complexity.
It definitely offered some breathing room. You see, with CAMT, companies have to make estimated tax payments throughout the year, similar to how individuals pay estimated taxes.
Right, that makes sense. You don't want to be hit with a massive tax bill all at once at the end of the year.
Exactly. But accurately estimating CAMT liability can be incredibly difficult, given all the intricacies we've discussed. Notice 2024-33 acknowledged this difficulty and provided a waiver on some penalties for companies who might have underestimated their CAMT liability.
So it's like a safety valve.
Yeah.
To prevent companies from being penalized for something that's inherently, hard to predict.
You got it. It was a welcome relief for many companies, especially those grappling with implementing CAMT for the first time.
This brings up an interesting point, though. What does the future hold for CAMT? I mean, are we going to see more changes, or is this the new normal?
That's the million-dollar question.
Yeah.
Tax regulations are constantly evolving, and CAMT is no exception.
So it's not a set it and forget it type of situation.
Right.
Businesses need to stay informed and adapt to keep up with the changes.
Absolutely. Now, it's important to remember that we've been focusing on the challenges. But for a balanced view, we should talk about the potential benefits of CAMT as well.
That's a good point. Every coin has two sides. What are some arguments in favor of CAMT?
One of the biggest benefits is the potential for a fairer tax system. Remember, CAMT aims to ensure that corporations with substantial financial statement income are paying a minimum amount of tax, even if they're using various deductions and credits to reduce their regular corporate income tax.
So it's about preventing companies from gaming the system, even if they're technically following the rules.
Exactly. It's about leveling the playing field and making sure everyone is contributing their fair share.
That makes sense.
Yeah.
Are there any other benefits beyond fairness?
Well, CAMT could generate additional tax revenue for the government.
I'm sure the government likes the sound of that.
Of course. This extra revenue can fund essential services, infrastructure projects, and other initiatives that benefit society as a whole.
So it's not just about collecting taxes, it's about reinvesting in the future and creating a better society for everyone.
Exactly.
Okay, so we've covered the challenges and benefits of CAMT. Now let's get into the practical side. What are some key dates and deadlines that companies need to know about?
Well, the most important date is the deadline for filing the CAMT return. For most companies, this aligns with their regular corporate income tax return deadline.
So they don't have to juggle two separate deadlines.
Typically not. But there are some exceptions, especially for companies with fiscal years that don't follow the calendar year. It's always best to confirm the specific deadline with a tax professional.
Good advice. What about those estimated tax payments we talked about earlier?
Right, those are crucial as well. Corporations subject to CAMT generally have to make estimated tax payments throughout the year, just like individuals. The deadlines usually fall quarterly, but the specific dates depend on the company's fiscal year.
So companies really need to have a good grasp of their estimated CAMT liability and plan accordingly to meet those payment deadlines.
Absolutely. And while Notice 2024-33 provided some relief for the estimated tax payments due in 2024, it's essential to stay updated on any potential changes or updates to those rules.
It sounds like the key takeaway here is to be proactive and stay on top of those deadlines.
You got it. And another important aspect is understanding the transition rules outlined in the proposed CAMT regulations.
Transition rules, what are those all about?
So since CAMT is a relatively new system, these rules are designed to smooth the transition from the old system to the new one. They address how to deal with existing tax credits, how to account for certain transactions that happened before CAMT came into effect, and other tricky transitional issues.
So it's like a bridge between the old and the new.
Yeah.
Helping companies adapt to the changes.
Exactly. And these transition rules can be quite complex, so it's vital for companies to get advice from tax professionals to make sure they're applying them correctly.
This is a lot of information to process.
Yeah.
For our listeners who might be feeling a bit overwhelmed, what's the most actionable takeaway you can offer?
I think the most important thing is to be aware of the CAMT dates and deadlines that apply to your specific situation. Mark them on your calendar, set reminders, and don't hesitate to reach out to a tax professional for guidance.
It's great advice to be prepared and seek expert help when you need it.
Well, we've covered a lot of ground today, from, what CAMT is and who it impacts, to the nitty-gritty of reporting the challenges and benefits, and even those crucial dates and transition rules.
Yeah, we've certainly explored the many facets of CAMT.
I have to say, your insights have been incredibly helpful. Thanks for demystifying such a complex topic.
Oh, my pleasure. I'm always happy to shed some light on these intricate areas of tax law.
And for our listeners, remember, this has been, kind of a high-level overview of CAMT. Yeah. So if you're dealing with this in a real-world situation, consulting a tax professional is always the best course of action.
Absolutely. Tax law is full of nuances, and getting professional guidance can help you navigate those complexities and make sure you're in compliance.
Now, before we wrap up, I want to leave our listeners with something to ponder. We've talked about how CAMT, aims to create a fairer tax system and potentially generate more revenue for the government. But what about the bigger picture, the impact on how companies operate? What's fascinating to me is that CAMT isn't just about taxes. It's reshaping corporate behavior in subtle but significant ways.
How so?
Well, with this increased focus on adjusted financial statement, Income companies are becoming much more strategic about their financial reporting. They're scrutinizing their depreciation methods, how they treat foreign income, all these details that can ultimately affect their AFSI and potentially trigger CAMT.
So CAMT is encouraging companies to think more holistically about their finances and how their tax planning aligns with their overall business goals.
Exactly. And if we zoom out even further and think about the long-term implications, could this lead to a shift toward more conservative accounting practices or greater transparency in financial reporting?
Those are great questions. It'll be interesting to see how these trends evolve as CAMT matures. I mean, it's still a relatively new system, and its full impact on the corporate landscape is unfolding as we speak.
Absolutely. As with any significant change in tax law, staying informed and adaptable is crucial.
Well said. On that note, we'll wrap up this deep dive into CAMT. A huge thanks to our expert for sharing their knowledge with us today.
It's been my pleasure.
And to our listeners, as always, this is not tax advice. For personalized tax assistance, please consult a tax professional. Thanks for joining us on Taxes Explained.